The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Thursday, the 16th of January. Welcome back, Jeremy. Good to have you here again.
Hi, Gareth. Good to be here.
And, well, it is an interesting week. It feels like peace might be spreading across the Middle East, which would be obviously a fantastic result for everyone.
Yeah.
And we've got Donald Trump being inaugurated in 4 days, which I'm sure he would say is closely related to the peace breaking out in the Middle East.
Absolutely.
Whatever happens, it will be an interesting 4 years for the US and more globally. So, yeah, lots going on. What's caught your eye across the week?
Well, we started with the return of the bond vigilantes, and I think it would be that bond vigilantes returned to the UK and started to give the UK government an economics lesson.
As if they needed one. Yeah, that's right.
Boosted by another strong jobs print from the US last Friday, the investors began to fully discount a no landing for 2025. And I think it's all part of this outbreak of American exceptionalism that consequently means that their economy is so robust that rates can be sustained for much higher for much longer. And commentators began to speculate, as often happens in these moments, that the next move in US rates might well be up, not down. So this sort of dollar stretching its bull run since September last year looked like a rerun of 2022 when we had a 20% dollar appreciation and we were all worried about the dollar wrecking ball. And I think for the UK, while our media made it look like a Rachel Reeves problem, it wasn't really. It was a dollar problem. And as the DXY, the value of the dollar, rises, it reaches a point where owners of dollar liabilities in other jurisdictions need more dollars because it's more costly for them to refinance or repay those liabilities. And the easiest, quickest, most liquid way of typically getting hands on more dollars is to sell their holdings of US Treasury bonds. So we had this situation where the dollar goes up and Treasury yields were going up, which is fine for the people in US markets. But with the UK gilt yield heavily correlated to Treasury yields, we had a situation where the dollar was going the other way while our gilt yields were rising. And this is very uncomfortable and made Rachel Reeves feel, which didn't look particularly uncomfortable, to be fair to her, she sort of shrugged it off. But there was a lot of pressure caused by this. So, yeah, that was the issue that we had. But as we've gone through the week, the pressure has definitely subsided.
Yeah. So we were suffering from our interest rates tracking US rates, so going upwards, or the yields on government debt rising, but we didn't have the benefit of the strong currency that they enjoy.
Or the strong economy, to be fair.
Yeah, true.
So, so those things we don't have, and that is uncomfortable. Obviously the key measure that people want to consider in scenarios like this is debt to GDP. And our interest rate bills, our funding rate going forward was looking very uncomfortable. It's still not great, but it's all moderated. That's what's changed.
Yeah. Then the inflation numbers came along. They were lower than expected, and suddenly everything's okay.
Yeah, so we've had inflation data in both the UK and the US, and particularly the UK, the number for December had moderated from 2.6% to 2.5%. Now, okay, above target, but at the same time, we had Wall Street, the earnings season kicked in with some strong results, particularly from their larger banks. And the idea got around that maybe the Trump tariffs wouldn't be imposed overnight, but more gradually. And everything suddenly changed. The dollar stopped rising, yields stabilized and have subsequently weakened. And what happened in the space of no time at all, cheap things went up, and that included our cheap UK equity market.
Right, yeah. It was a pretty quick rally, wasn't it? It was sort of sudden, over the course of a day or so, suddenly everything felt very different really quite quickly.
From what I can see in the last 3 days, the FTSE 250 is up 3%, which doesn't sound like a lot, but there's some quite big moves in there. And the price action of the market to some of these trading updates that we've seen have been pretty positive, actually.
No, it's right. I mean, I guess if we can keep inflation contained and if the US economy can carry on growing and potentially continue to grow itself and drive global M&A activity or a little bit more positivity across all markets, then that could be a pretty good scenario.
Yeah.
So in terms of the UK price action, what sort of things, were there particular stocks or groups of stocks that reacted particularly well? What did you see?
Well, following these trading updates this week, it seemed that all they had to do was to guide in line or say things are going to be towards the top end of the range of expectations. And stocks on my list that I'd noticed this week are stocks like Genus, Trustpilot and Hunting, all billion plus market cap companies, or there or thereabouts, certainly in dollar terms. They all sort of guided in line more or less or up a bit. And in each case, the shares were up sort of between 15 and over 20%. So I think it indicates that the UK market is cheap. It just has been lacking a reason to buy. And we know the liquidity issues and the fund flows issues. But Vistry had a trading update. And I think the main news from it was that this time it didn't warn, having, I think, previously the 3 occasions it had warned. Shares are up about 20%. So there's some real value out there in the UK small and mid-cap space. I think the area where it's a bit trickier is in companies that are employing a lot of people on low or minimum wage, and they've got businesses with retail type or distribution type margins. So we saw a host of retailers, mainly last week, but a couple this week, continue this theme of saying, yeah, trading's been okay, but going forward, we're having to make accommodation, make changes, and we're having to get our head round that employing people with these new budget changes regarding national insurance means that it's just more expensive. Our cost base has changed, and we've got to work on ways to mitigate this going forward. And that's caused, understandably, a bit of concern.
Yeah, it has. I mean, it's sort of strange because, as I think I said before, the analyst in me would hope that as soon as those national insurance changes are announced, and everyone knew they were coming post the budget, companies and investors should have adjusted or thought through their 25 and 26 models and worked it all through. But it seems that hasn't happened. And maybe everybody was hoping that the world might feel that much better and, they'd be able to work their way through it or do other things to mitigate. But perhaps that's not been possible. So now reality's biting, albeit a couple of months later than we'd have thought.
Yeah, absolutely. Yeah, I think that's right. So what about you? What did you notice this week among the companies?
So we've had an interesting start to the year from the progressive client perspective. 3 stocks in particular this week: Petro Matad, Xaar and GAMA. Petro Matad, the Mongolian-based oil and gas exploration and now production business, they had a pretty good update actually. Their Heron 1 field seems to be producing pretty much in line with expectations and hopefully moving to revenue generation very soon. And they were awarded a new exploration license, which I think was a bit of a surprise, certainly a surprise to me, but hopefully good news and a bit to go for Petro Matad. Xaar, the manufacturer of printhead and related technologies, they had a pretty good end to 2024. Profitability was slightly ahead of expectations, or at least in line, and cash was strong, but that was based on lower revenues. That pressure is continuing into the rest of 2025, but there are a number of decent opportunities out there. So net, we did have to trim our estimates, bring our estimates down for 2025, but the shares rose quite strongly on the back of the announcement. Perhaps there was a degree of relief that things weren't worse than had been expected. And I think there is still some pretty good opportunity for Xaar in particular in some of the Chinese markets around EV, the batteries for EVs and various other markets. So there's a lot to go for. And it was interesting that the market was happy to alight on the positive side of that news release. And then finally, GAMA, the telecoms business, they made a nice and decently sized acquisition in Germany. It was an interesting start for the year. They bought a large SME-focused provider of cloud telephony business for about 160, 170 million pounds. There was also an inline trading update. So in terms of the corporate, they're off to a decent start to 2025. Hasn't been reflected in the share price, actually. The market, perhaps I don't know whether they're worrying that the price paid was a pretty full price, or maybe there are other concerns out there, but that hasn't been a great result.
I noticed that it didn't seem to follow through. The share price has been recovering quite nicely, but I wondered whether the market didn't like the idea that it was doubling down in Germany, while I'm sure from a sort of operational perspective, they're keen to get critical mass in Germany, which I think has been not a problem area for them, but it's not grown as quickly as I think they would have liked when they first went into Germany some years ago now. But of course, the German economy is not in great shape right now. So maybe the market doesn't like the idea that it's increasing its exposure to Germany. I don't know.
No, it could be that. I mean, but they made a decent-sized acquisition in Germany on the back of Cisco on the back end of last year.
Yeah, which the market quite liked, I think.
Yeah, absolutely. And this feels like a pretty good fit with that because it's got a good number of customers and it's really extending the reach into that market. And yes, I mean, it has been a challenging market. And I think it's the growth across the market, not just GAMA, hasn't been as fast as people would have hoped. But I think if there's one company which has got many years track record of delivering steady, strong growth and turning that growth into profits and cash, it's GAMA. So hopefully they can prove the market wrong. But we'll keep an eye on that and see how they adapt over the coming quarters. So those were the three bits of progressive news. How are things looking for next week? Is there much on the economic calendar?
It's quite quiet. We've got UK unemployment figures on Tuesday, which are expected to be unchanged at 4.3%. And we've got average earnings reported at the same time running at 5%, which is down from the previous month's 5.2%. So I think that's going to be looked at in terms of the sort of inflationary implications, particularly for the services sector. I think actually the risk point for next week is going to be from Japan. I know I always say this, and
sometimes it's right.
Yeah, in July last year it was right, but only for about 3 days, as I recall. But we have got Japan's inflation data on Thursday, which is actually running at 2.9%. And the market expects this to be going up to somewhere, at 3 or just above 3%, which in the context of its policy rates at 25 basis points is significant. I mean, they're suffering an inflation rate that's not dissimilar to the US or Europe right now, in fact, higher than most. And this inflation data is quickly followed on Friday by the policy rate decision from the Bank of Japan. And the consensus is for this to increase, and it could increase quite significantly. The estimate I saw is that we're going to see the policy rate double to 50 basis points. So in the context of what happened to the carry trade when a similar thing happened in July last year, one should buckle up. And maybe it's not just the inauguration next week that is the main risk point.
If the carry trade comes and spoils Trump's inauguration parties, that would be an interesting start to the Trump presidency, wouldn't it? So, yeah.
And of course, next week, we're going to have the continuation of the Senate hearings into the Trump appointees. So we'll get to hear what these people think and how they view the world. So I think we'll be getting some early indications of what the new world, according to Trump, is going to look like. But I think, in essence, that process is going to take 2 to 3 months. So I think we're going to be living in a world of heightened uncertainty and volatility for a couple of months at least yet.
That's right. And it could kick off anytime next week, especially with Japan.
Well, let's see. Yeah.
Lot to look forward to. And we'll catch up this time next week and talk it through.
Okay. Look forward to it.
Thanks for your time.
Bye for now.
Brought to you by Progressive Equity.